Hello everyone, welcome to another episode of the Daily Way Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 4th of August, 2023. Alright everyone, let's get into it. So apologies for missing yesterday's episode. Unfortunately had a pretty bad headache that made it kind of impossible to do a refuel, but I'm back today, of course, with a longer than usual episode to make up for it. So let's kick off the news. So first of all, we have this interesting kind of scoop, I guess, like that one of the media companies got. I don't know exactly where this is from, but Loomdart on Twitter shared this screenshot here that the US Department of Justice, or the DOJ, officials are considering fraud charges against crypto exchange Binance, but are concerned about the cost to consumers, according to people familiar with the matter. Now, I think it was already kind of common knowledge that the DOJ was targeting Binance. I think I'd mentioned it before on the refuel, but the fact that they were considering these charges, or still are considering these charges, but are concerned about the cost to consumers is something new and something a bit weird, because it basically opens up a can of worms here of different takes, and I'm going to give a few of my own on this. But essentially what they're worried about is spurring panic in the crypto markets, or spurring a bank run on Binance. Like, for example, if the DOJ was to bring these charges against Binance, for sure people would withdraw from Binance, right? And then for sure the crypto markets would at least temporarily have a one of their dumping events that they like to have, right? So the fact that the Department of Justice is worried about this is pretty unusual, right? At least it's unusual for me. I mean, I'm not an expert on the DOJ, right? Maybe this has been done in the past, but essentially the only other thing that they would do if they don't want to bring charges against Binance is basically fine them. And I think a fine would be seen as bullish by the market, because the market would basically say, well, the DOJ is fine, is fine with just fining Binance, getting them to admit that they did something wrong, and allowing them to continue on operating just fine. Now, the reason why this would be, I guess, like a negative thing, or something that would be good, I guess, for crypto in terms of like not having a bank run on Binance and not having the market crash. But what it would do is it would basically say that all the dodgy stuff and all the shady stuff that Binance has done in the past is okay, and everyone following the rules, like Coinbase, for example, in the US, is basically on that same level. So the Coinbase, as far as I know, they probably had one or two things I think they got fined for. I think there was some insider trading stuff that happened with some of their employees, but generally they've been okay, right? And Kraken and other US-based, a lot of other US-based exchanges, not all of them, but the big name ones, right? So from that perspective, how would you feel as Brian Armstrong seeing the US Department of Justice having these charges to bring, against Binance, but not bringing them against them because they are worried about, such and such, and then also basically saying to Binance that what they did is forgiven. Now, I think that there's two ways you could go about this. I don't know how Brian Armstrong and people the executives at Coinbase would think about this, but there's two ways you could think about this. One, you could get really pissed off about it, right? And you could basically say, hey, we played by the rules the whole time and we still got sued by the SEC, right? The SEC and DOJ are separate entities. The SEC can't bring criminal charges against anyone, but the DOJ can. Just a kind of explanation there to give some more context. But they could be pissed off about it, or they could see it as a positive in that the DOJ actually cares about making sure that people aren't harmed in the crypto ecosystem, and that the kind of, I guess, like, the fact that they're only fining Binance and not bringing these charges against them means that this kind of overhang is gone for now, at least, right? And I doubt Binance is going to continue to be dodgy and shady going forward if they get away with this. Maybe they will. I don't know, right? I mean, I've not been, you guys know I'm not a huge fan of Binance generally, but it does seem like they're trying to clean up their act somewhat, right? So it depends on how they... But at the end of the day, it doesn't really matter how they feel about it either, like Coinbase and Brian Armstrong. I think that the DOJ is not going to care, but just from like being in crypto and kind of running through this all, that's kind of what's running through my head. And Loomdart had some takes here that he screenshotted. He goes, he's confused by this because this sounds like they couldn't find anything and are scared of a battle, but are trying to negotiate, or they're implying Binance is insolvent. If they press charges, it'll implode. No other situation makes sense. I mean, I guess I kind of see that. The thing is that there can still be a bank run even if something is not insolvent, right? Because like Binance could have all customer deposits be fully solvent. Let's just say they have $50 billion of customer deposits that they're able to redeem, but the thing is that it doesn't just mean that they're scared about insolvency risk. It's more of the fact that they're scared about consumers being hurt and causing extreme volatility within the crypto ecosystem, which I guess is a positive because I think the SEC has traditionally not been concerned about this. Like the fact that they say they want to protect investors and then they try to label everything as security when obviously recently they had the judge in the Ripple case rule against them, saying that these assets cannot be securities. The security is the investment contract, basically. At least that's my understanding of it. So at least the DOJ seems to want to, not harm everyday users, whereas the SEC, they're just going around slashing. They don't care who they hit, right? They're like just indiscriminately hurting everyone, even though their mandate is to protect investors, which I guess we all know that that's bullshit at this point, but. Yeah, so that's the latest there. I don't think there's been an update since this came out, I think yesterday. But yeah, interesting times in the crypto kind of like legal world going on here. And I'll keep you guys up to date on as that evolves. All right, on to the Ethereum news. So Andrew here has a screenshot of Tim Beiko's recap from the latest All Core Devs execution call here. You can see a bunch of updates. You can read this. I'll link it in the YouTube description below. But I think one of the major updates, I guess, the ones that we've been tracking closely on the Refuel is these test nets and these dev nets that are happening for EIP 4844, for Denkun, the next Ethereum upgrade happening here. And there's an update here saying that the EF DevOps team launched a DevNet with 2.1 million validators with a similar client distribution to mainnet. They ran into some finalization plus block gossip issues and will be working with client teams to diagnose and fix those in advance for the whole Sky launch, which is the next test net that is being launched for Ethereum on September 15th, or I guess is planned for September 15th, which is planned to have 1.5 million validators. Now, astute observers among you will know that these validator numbers are way above what mainnet is right now. So mainnet is what, 600,000 or something like that. I mean, am I butchering that? No, I think it's more than that. It's 700,000, plus 75,000 pending. So, almost 800,000 validators. Whereas this testnet, the whole Sky testnet is going to launch with almost double that. And of course, the recent DevNet with 2.1 million validators is almost 3 times that. So the reason they're doing this is because we know that if the current pace continues of ETH being staked, validator counts are going to go up, and then the validator count going up can lead to some issues around the chain stability and things like that. And there are various proposals in the works, I guess, to curb that at least, or at least to alleviate that. But in the meantime, they want to test for this through different test nets. That's why Whole Sky is launching with almost double the amount of validators that are on mainnet right now. But anyway, you can read the full recap here. I'll link it in the YouTube description below. All right, speaking of upgrades that are coming to Ethereum in the future, PBS or ePBS is something that has been talked about for quite a while now, and I've talked about it on the Refuel for quite a while. And there is an evolving kind of research that's spun off of that around something called PEP-C. So there is a new FAQ about PEP-C if you want to learn about it here, which was linked by Barnaby, which you can kind of give a read. It basically goes over everything you need to know about PEP-C. But basically what it is, and it's pronounced PEP-C, it stands for Protocol Enforced Proposer Commitments. PEP-C was originally proposed in the post Unbundling PBS, published in October 2022. It is intended as an enshrined protocol gadget allowing validators or proposers to enter into binding commitments over the blocks they produce. So essentially, this is an offshoot, or I guess a complement to ePBS from my understanding. There is a lot of stuff that goes into this. It's kind of I'm still digesting this and still trying to wrap my head around exactly how this kind of works and what the implications are of these sorts of stuff. But this FAQ does a really great job of breaking it all down. So I just wanted to highlight it for you guys, and you can go give this a read for yourself. I'll link it in the YouTube description below. But this is the kind of stuff that, again, is on the bleeding edge of research when it comes to Ethereum. I don't know if it's going to go live next year in a network upgrade. It might be the year after. It's hard to tell. If I had to put money on it, I think I've said it before, I don't think it would go live next year. I don't know if PBS is at that point where it's ready yet. I don't think Pep-C is ready yet to go in either. And I think that there are other things that the core developers want to prioritize next year, such as Verkle trees and statelessness and light clients over these sorts of things, because these things, I guess, they are an immediate issue, but not like an issue and that's critical to fix. Because right now we do have MEV Boost, obviously as sidecar software, and enshrining that as part of the protocol is something that we want to do, but we don't want to rush it, because rushing into it what that results in is basically a design that may need to be changed in the future. And obviously, with Ethereum's roadmap being so kind of like big right now, and still so long until we complete it, at least 10 years away, and the desire for, I guess, generally the Ethereum community to have that desire for the Ethereum protocol to generally ossify over time. When you put these upgrades in, you want to do it right the first time. You don't want to have to change it later on because you missed something. That's why these things take quite a while to get in. Not to say that we couldn't change it if we had to, but rather get it right the first time, right? So anyway, you can go read this Pepsi FAQ. I'll link it in the YouTube description below. All right, so I mentioned the other day that Nethermind and Eigenlayer had basically cemented a partnership together to build a bunch of different things. Now, there is this new blog post out called Strategic Partnership between Nethermind and Eigenlayer that dives deeper into exactly what they're going to be doing together. The high level kind of TLDR is that they are going to be working on the alignment of a safety such as censorship, attack resistant chains, and creativity when bringing restaking to the Ethereum ecosystem. So there's more detail on the blog post for you to check out. I'll link it in the YouTube description below. But it's great to see that something like Eigenlayer, which is poised to be a big player within the Ethereum ecosystem, partner with Nethermind, who is obviously a big player in the Ethereum ecosystem, the second most used execution layer client. But Nethermind doesn't only develop, or the Nethermind team doesn't only develop the Nethermind client. They also work on a bunch of other things within the ecosystem. They do a bunch of work with Starknet. Now they're working with Eigenlayer. I'm pretty sure they do things like security audits as well. Last time I checked, their team was like 200 plus people. So they're doing a lot of great work. But yeah, if you want to learn more about their partnership, you can. I'll link this in the YouTube description below. All right, so a big update from Peter today regarding Geth. So he says here, today we reduced the memory requirement of Geth during SnapSync from 14 gig to 2 gig. Benchmark's still running, numbers might change a bit. And the epic change that made it possible, I think, was like 4 lines of code change, which is always funny to see. But yeah, so basically what this means is that during SnapSync, when you're syncing Geth with SnapSync, it only requires around 2 gigabytes of memory instead of 4 gigabytes at 14 gigabytes. It doesn't mean that when Geth is fully synced, it only requires 2 gigabytes to run the Geth client. No, it still requires, I believe, around the same memory here, but that is a pretty substantial improvement. The 2 lines that were removed were responsible for 12 gig of extra memory usage during SnapSync, which is just funny when you look at these things. These are the kind of things that get caught when clients are doing kind of like maintenance and improvements and efficiency improvements on their code base here. And this is the kind of stuff that gets caught during kind of like code reviews and stuff like that. So it's great to see that this was caught here. If you're using Geth, I don't think this has been pushed to production client just yet, but yeah, I'm sure it's coming in the near future. All right, just a reminder here that the ceremony, I guess like the KZG ceremony is still ongoing. I believe that there's almost 20 days left still here, and the lobby is empty, so you can go and get your contribution included if you would like. Carl Beeks here said that he also cleared 8,000 addresses from the blacklist. So if your address was accidentally put on the blacklist, then it has been cleared. And as I said, you have about 20 days left to participate in this. Now, there has been 133,000 total contributions over the life of the KZG ceremony so far, which has far exceeded my expectations, or at least my most bullish expectations of 100,000 unique contributions. So yeah, kudos to the team that worked on this for all the great promotion that they have done and all the great work they have done for making this available to everyone to participate in. All right, Terence from the Prylabs team has put out a tweet thread where he says, a tweet thread on my teammate Akaki's presentation on the latest EIP 4844 economic analysis. So this is a really great thread. I suggest reading it. It's not too long. I'll link it in the YouTube description below. But the economics of blob transactions, or at least EIP 4844 style transactions, are a bit different to, I guess, like call data and general Ethereum L1 kind of transactions here. And you can see here that the TLDR is that EIP 4840 gives a new market for blob space. Ethereum helps rollups with more data availability. In exchange, rollups L1 data posting cost becomes cheaper, enabling scaling. L1 data posting cost is the biggest part of the rollups cost, i.e. sequencer cost. Now, with 4844 pricing, it's currently set to 3 target blobs and 6 maximum blobs per block. It has dynamic pricing similar to EIP 1559, and then you can see here what the dynamic pricing is. And then Terence continues with explanations here, but basically, There is a threshold where smaller rollups with slower rates may prefer call data the call data market still, and finally, rollups can optimize their total cost by joining in blob posting. Posting cost sharing also doesn't have to be proportional. So essentially, with this new fee market, there is cost sharing that can be had. It depends on the size of the rollup, whether it's beneficial to basically go for blobs or go for call data. I think the main, efficiency and the main cost saving with blobs comes from the fact that if there is sustained fee spikes on layer 1 Ethereum, such as going up to like 50 or 100 Gwei, that spike won't affect the blob transaction market, because blobs are separate to the normal L1 fee market, as I've discussed before. So that really is the biggest kind of upgrade there in my mind, rather than the cheaper fees obviously are a big upgrade as well, but having that certainty over fees is a huge upgrade too. But this thread was put together based on slides that or presentation that Akaki gave that you can check out at the end of this thread, which I'll link in the YouTube description below for you to do so there. But yeah, that's it on that one there. Moving on. So some big layer 2 news over the last couple days. So Base is now open for bridging. So you can bridge using the official Base bridge now. You don't have to, I think you could use it before, but basically it's now open for everyone, and Base is officially going to launch on August 9th here, which is great to see. Obviously they said early August, so they are launching on August 9th. So they're calling this launch On-Chain Summer. Now, this is something that Jesse Pollack, the lead of the Base effort, has been kind of memeing into reality for a little while now. You can connect your wallet here. You can mint one of these NFTs and bridge in to mint for free at this website, onchainsummer.xyz. But On-Chain Summer is basically an initiative where they're working with 50 of the best builders, products, artists, and brands to showcase emerging on-chain culture. Every day in August will bring you something fun to do on-chain, a first of its kind on-chain festival. So this reminded me immediately of what Arbitrum was doing with their, the name eludes me right now, but you guys remember the kind of thing Arbitrum was doing that basically ended up clogging the chain and causing fees to spike, and they paused it because it was so successful. It was the Arbitrum Odyssey, that's what it was called, and they never restarted the Odyssey from my knowledge. But this seems similar to what they were doing there, and obviously it was super successful. It got a lot of people to bridge in. Obviously people were doing like airdrop farming and stuff like that because it was before Arbitrum did their token. But it's going to be interesting to see with Base what happens, because Base has multiple times said that there's not going to be, or Coinbase has said this, that there's not going to be a token for Base. But that's not going to stop airdrop farmers, because as I've said before, the cost to farm airdrops is very cheap. It's not zero, right? There's a time cost and there's also a gas cost involved depending on what you're doing and other such costs. But the costs are very cheap. And if there's even like a 0.1% chance of that paying off, you're going to do it. And it's not just one person doing it. It's groups of people doing it. It's many people around the world doing it. It's anyone who can basically use a computer doing it because it's very easy to do. You just bridge into Base with a bunch of different addresses, right? Maybe you pay the ETH L1 gas fee to do that, but I'm sure there's going to be ways to bridge into Base from Coinbase for relatively free as well. So there's multiple different ways to farm a potential airdrop, even though they've said that there's not going to be a token, because technically, I guess you could say the token for Base is just coin stock. That doesn't really make much sense, but Base is also built on the OP stack, and people are speculating on OP because they can't basically speculate on anything else right now, and that's why the OP price has slowly crept up over time. But, that still doesn't convince people that there's not going to be a token. So I'm very curious to see what kind of activity we see on Base through this on-chain summer thing, of people just airdrop farming versus people actually bridging there because it's cheaper, it's faster, there's a lot more to do on there. I think it's going to be an exciting time. As I said before, I expect Base to onboard a lot of new people that haven't used on-chain products before from Coinbase to Base. But yeah, still in its early stages here, and it's not even officially live yet. Still about 5 days out from being officially live, but we have an official date and we have an announcement of this initiative that they're doing. So you can go check this out at onchainsummer.xyz. I'll link this in the YouTube description below for you to do so. All right, the second major announcement over the last 2 days in the Layer 2 space is Offchain Labs, the developers behind Arbitrum, announcing something called BOLD. So not BOLD as in B-A-L-D, not the meme coin, but BOLD as in B-O-L-D, which stands for Bounded Liquidity Delay, which is a new dispute protocol that enables permissionless validation for Arbitrum chains, potentially removing the need for permissioned validation and dramatically improving decentralization. So I guess plain English, explain like I'm five, This basically means that Arbitrum chains, not just Arbitrum One, but Arbitrum Nova and other chains out there, are going to be is going to be the most decentralized L2s out there very, very soon because, as far as I know, they're going to be the only L2 chain with permissionless validation. And that means permissionless validators and permissionless fraud proofs from my reading of these things here. So there are full details for this is in the in the blog post here, which I'll link in the YouTube description below. But this is how they summarize it. They say here, every layer 2 system has to cope with the problems of delays when settling their state to Ethereum. Bold is an evolution of Arbitrum's dispute system, culminating in a much more robust approach. To our knowledge, Bold is the first practical challenge protocol that supports efficient all versus all disputes. It guarantees fixed upper bounds on confirmation times for optimistic rollup settlements and ensures a single honest party in the world can win against any number of malicious claims. Disputes in Bold are tied to deterministic execution of an L2 state, not to a particular staker or entity. This means anyone who agrees with a state can defend it until a single point of disagreement is found. Because the honest L2 state is deterministic, honest parties will always win if participating, as evil ones cannot fake proofs of execution. So not only is this going to enable permissionless validation, this is a, built from, I guess, like the ground up dispute mechanism here that is going to be integrated within Arbitrum chains. And the code is now available for you to check out if that interests you. But that's really interesting because, people are very quick to write off optimistic rollups, right? They're very quick to write them off for a bunch of different reasons. But I think that Arbitrum stands kind of alone in terms of innovation when it comes to optimistic rollups because right now, technically, OP chains, Optimism, Mainnet, Base, other OP chains, they're not optimistic rollups because they don't have fraud proofs because the OP stack does not have fraud proofs right now. And as I've said before, or as I've speculated before, I kind of feel like they're going to just leapfrog that and go straight to validity proofs because they have this, open OP stack. They have proposals already been submitted by validity proof teams or teams building validity proofs to integrate that into the OP stack. So it feels like that they're not even going to bother with fraud proofs. Whereas the Off-Chain Labs team, they seem to have said, no, you know what, we can make a really cool system for fraud proofs and we can do it in a permissionless way, and we can innovate here. So they may stand alone as the only optimistic rollup going forward. Now, it remains to be seen if they integrate validity proofs and if that actually better serves the Arbitrum ecosystem eventually. I'm not sure. That's definitely getting into the technical weeds there, but it's great to see that they haven't just abandoned fraud proofs, right? Arbitrum 1 has fraud proofs right now. It's permissioned, but with this new kind of like bold mechanism here, they're not only going to be permissionless, but it's going to be a whole new mechanism. And people will often bring up like this 7-day delay with optimistic rollups in order to withdraw from the chain. The 7-day delay is not something that, it's not arbitrary, but it's not something that is set in stone. It was chosen because that was kind of like the safety margin of how long it would take to submit to detect fraud. But with this new approach with Bold, they say here, we have invented a new approach to that validation that gives us a fixed upper bound 7 days of additional delay on confirmations without suffering from delay attacks. So from this kind of reading, it seems like they could reduce that 7-day delay if they wanted to, or if governance agreed on it. But at the same time, it's also proven not to be an issue. I remember how much FUD there was about this. Like back when optimistic rollups were coming onto the scene and going live, everyone was going, it's dead on arrival because of that 7-day withdrawal period. That didn't materialize because we have bridges, right? I know I've said before that bridges can be dangerous in their own right, but at the end of the day, if you are putting like large sums of money on these L2s and you want to go back to Ethereum mainnet, well, you're going to probably wait the 7 days, right? You're going to be comfortable waiting the 7 days, or you can just use the bridge and take on the extra risk. Now, the extra risk from bridges, I think, is overstated a lot of the time, depending on the bridge that you use. Like, if you're just using something that's basically an AMM, hop or something like that, that basically allows you to swap in and out, the risk is passed on to the liquidity providers in that sense. So you don't really hold the risk anymore once that is complete. Obviously, during the transition, there is a risk there, but I just generally think that it was so overblown, that risk around that 7-day withdrawal period being a being something that would kill optimistic rollups, because obviously it hasn't. Arbitrum is still the leading optimistic rollup. OP Stack, it's not technically an optimistic rollup yet, but it's still obviously trying to be that, or at least building in that ethos there, has a lot of activity on it. So yeah, I think those concerns were completely unfounded. But anyway, you can go check out this new thing from Off-Chain Labs, new bold thing. I'll link it in the YouTube description below for you to do so. All right, so something interesting that Bartek from the L2 Beat tweeted out. He said, since launching Starknet on November 2021, from the point of view of L1, we are running version number 11 of it. It got upgraded on average every 2 months. And so Bartek says, he's thinking about introducing an ossification factor for rollups that would measure the time since last upgrade times the TVL. This is actually pretty interesting because it's not really something that people think about when it comes to any on-chain contracts, right? Because, for example, say you have a contract, because at the end of the day, these L2s are just contracts on layer 1. But let's just say, for example, or at least the bridge is, right? I'm not going to get into the semantic argument here, but let's just say, for example, there is a smart contract that exists on Ethereum L1 for 2 years. And then the community or developers, they say, we're going to upgrade this and we're going to add a bunch of functionality to it, and not redeploy the contracts, basically upgrade the existing contracts. Well, then those contracts aren't the same thing anymore, right? They've changed. They're not the same thing that they were for those 2 years. So the security assumptions have changed on it, because now there's additional security risks that weren't present in those 2 years. It basically resets your Lindy effect to 0. And it introduces more risk, essentially, right? So I think that this metric would be good not just only for L2s, but for all smart contracts. Obviously, the dream is for all the contracts to be immutable, and the only way upgrades could be done is by deploying a new set of contracts. That would also reset the security, of course, but the existing contracts would exist in their current state. And that's what Uniswap does with their different versions. V1 still exists, V2 still exists, V3 still exists, and when V4 gets enabled, they're all separate systems. They weren't upgraded to replace the existing system. So from that point of view, most contracts aren't like that. They're upgradable, especially L2s, for now at least. So having that metric on L2 Beat, I think would be really great from a safety perspective. You could see like how long it's been out there for, how long, since its last upgrade, and things like that. So I'm hoping that L2 Beats definitely adds this metric to their website. All right, I talked a lot about shared sequences on the Refuel over the last few months especially. Now, Sanjay here has a great thread out explaining how he believes shared sequences may be way more powerful than we thought. And he says, the Espresso team recently laid out how shared sequences could enable atomic composability, even flash loans. And here's how a flash loan would work. And he has a nice graphic here describing this. Now, this requires a read of this thread and to go view the graphics yourself, so I'll link this in the YouTube description below. But there is a lot of work being done on the sequencer front, guys. I know that a lot of the people who are clueless about L2s on Twitter and elsewhere like to say that, sequencers are this huge, are this centralized point of failure for L2s, and all the signatures are centralized. That means the L2s are centralized, and it's never gonna be decentralized or permissionless or anything like that. That's not true at all. There are going to be ways in the future for a lot of these L2s to be a decentralized sequencer. And at the end of the day, the sequencer's risk and the centralization risk around them is far overblown. As I've said before, a sequencer just basically orders and submits transactions and processes transactions. The biggest risk is censorship. So say you have like one sequencer. That one sequencer is responsible for ordering and censorship resistance. Well, you don't really have much you don't have a lot of guarantees around censorship resistance there. But if the L2 is constructed correctly, you could still submit your transaction on L1, right? And, force withdraw your funds if the L2 was censoring you. Now, let's just say you had permissionless sequencing and there was 10 sequences, 10 different sequences run by 10 different entities. The chances of them censoring you, of all of them censoring you, is 0. And that's, you need all of them to censor you for your transaction to not go in. It's a one of n trust assumption where basically even if 9 of them were censoring you, that one will pick up the transaction and process that for you. And even if all 10 of them were censoring you, you could still use L1. So I think that the risks around sequencers are vastly overblown and people's kind of concerns around them are vastly overblown. In saying that, the sequencer tech is in its infancy right now. Shared sequencing looks very promising because, as Sanjay says here, it could enable this composability and interoperability between the different L2s if they're part of the same shared sequencer network that allows them to basically act like one big monolithic chain, but in a modular kind of sense. And that has been the main criticism of the modular roadmap. People saying, oh, it breaks composability, it breaks interoperability. No, it doesn't. It just changes how we do composability and interoperability, and we can do it. It's not something that can't be done. We're at the beginning stages of this. It's definitely going to evolve over time. There's a lot of teams working on this, and if you want to learn more about how it's going to all work, you can go read this tweet thread, which I'll link in the YouTube description below. All right, Push V2 has been launched. So they said here, today we're officially launching Push V2 and an array of exciting new features. New yield farming rewards via Push Fee Pool staking, incentivized chats, push spaces, and customized profiles. Now, for those of you who don't know what Push Protocol is, they're a communication layer for Web3, basically trying to be a decentralized layer where different people can do different things, such as have like push notifications for different on-chain activities. You can have peer-to-peer chats, decentralized chatting. You could have yield farming and things like that as well, which is obviously all detailed in this kind of like a blog post here on Medium. It's a video, but it's also a blog post. So you can give this a read, all about what Push V2 is and what they're kind of aiming to do here. And you can also check out more detailed information in articles that are linked here. So yeah, you can go check that out for yourself. I'll link it in the YouTube description below. For those of you who may not have heard of Push Protocol before, Push is the rebranding of EPNS, which was Ethereum Push Notification Service, and it's a project that I invested in quite a while ago. They've been building for quite a while, but that might be the reason why you hadn't heard of it before, because they did do a rebrand a few months ago to Push Protocol, and now they have V2 out there, which is a very exciting time for them there. All right, Nocturne, which is building a on-chain privacy for Ethereum, has put out a new blog post all about stealth addresses and shielded pools. So this was published yesterday, and they said, in our last thread, we introduced anonymous payments, EIP 5564, and some outstanding UX challenges. And I think I covered that thread on the Refuel. And they describe here how Nocturne addresses these challenges by combining a contract internal stealth address scheme with a shielded pool. And in this Twitter thread, they jump into this design, which you can read. I'll link it in the YouTube description below. And they also have a blog post jumping into this as well. So for those of you who thought that privacy was dead on Ethereum because of the Tornado Cash sanctions, it's not. There are so many teams working on privacy right now. Nocturne is one of them. There's Umbra Protocol. There is different versions of Tornado Cash mixes on L2s. I remember I covered it back in, I think around ETH Denver. Amin Soleimani put out one on Optimism that was different to Tornado Cash, but in the same spirit. There is obviously Aztec building their encrypted layer 2 or their fully privacy by default L2. There are so many things being worked on in the privacy front that, I'm more bullish on-chain privacy than I've ever been before. So yeah, you can go check out Nocturne's thread and blog post. I'll link that in the YouTube description below. All right, last up here is just a tweet that I put out over a couple of days ago now that I wanted to talk about. And I know I'm over time here, but I'll make this quick or relatively quick. So I said, I know many people that blew themselves up in the COVID dump of March 2020 after holding and accumulating all throughout the bear of 2018/2019. Some people recovered, others never made it back, and some left crypto altogether. Best to keep this in mind when future high volatility events come around. So some people took this tweet to mean that I thought that we would be having like one of these future high volatility events really soon, and that we dump and then everyone would blow themselves up. No, that's not what I was saying at all. The point of this tweet is to basically say that the worst thing that can happen to you is blowing yourself up in this ecosystem. Whether that's blowing yourself up on leverage, whether that's overtrading, whether that's basically leaving the ecosystem after, basically losing money and losing faith because the market hasn't done what you wanted it to do, making the wrong investments. There are many different ways to blow yourself up. Getting rugged, right? Losing funds in a hack, losing funds on a centralized exchange, going offline, like FTX, stuff like that, right? So there are many different ways to blow yourself up. And the worst thing is the people that I saw blow themselves up in March 2020 over that massive COVID dump that we had. Now, of course, no one saw that dump coming because it was a black swan. It was a true black swan. This COVID thing, no one knew what was going on. The markets all panicked, dumped. And then obviously after that, it recovered. It took a little while to recover after that. If you look at the charts, everyone kind of seems to block that out, that, we just recovered straight after the COVID dump. No, there was a very scary period for the few weeks following that dump of people kind of questioning, are we actually bottomed again? Because ETH went to $90 again, right? Everyone was questioning, hey, have we actually bottomed again? What's this COVID thing? This seems really serious. There's these lockdowns happening, blah, blah. What's going to happen here? No one knew, right? It was very, very scary. So people blew themselves up because they were on leverage, or they thought they could out trade the market. They thought that it was going to be really bearish, so they sold all their crypto, they stayed in cash, and then the market got ahead of them and they tried to buy back in, but they've obviously bought a lot less than what they had. So I saw many people do this. Now, the reason why I tweeted this out was because I do believe that there's going to be more of these high volatility events. Probably not as bad as the COVID dump. That was really bad. But in bull and bear markets, you have these events. And we had one recently with a lot of the non-ETH and BTC coins tanking really hard. And this was, I think, people like to attribute it to the SEC case brought against Coinbase and Binance. But I think a lot of coins were already just heading for that. If you look at the chart, they were already bleeding out. But if you want to look at some of the ones that kind of, where they went from, what they moved in a day, there were like 20 to 30% dumps on these coins in a single day. That is what I consider a high volatility event. And I'm sure there were some people out there that tried to trade this or blew themselves up because they were on leverage, or maybe they thought to themselves, wow, this is really bearish, I'm going to sell here and it's going to go down even further. And then, of course, some of these things recovered pretty violently, especially once Ripple won their case. And getting chopped up in this crab market is essentially what people are doing right now. So that not only do these high volatility events stand to wreck you, but trying to outtrade the market, especially in a crab market, just chops you up. And I've seen it happen time and time again. So the main point of this tweet is to basically say, be on your toes in these events, focus on the long term. I know a lot of you guys out there are long-term investors. You don't really care to trade. But I know some of you out there are traders. At the end of the day, if you're a trader, you're taking on that additional risk. You should understand that risk. You should understand the fact that you have more of a chance of blowing up than others. But even if you're not a trader, you can blow yourself up very easily as well, even not just being on leverage. As I said, you could get rugged because you put all your money or put a lot of your money into a new smart contract because you're trying to chase gains, like what was happening in DeFi summer, right? Or what happened recently with the Bold thing. I'm sure some of you probably put some money into that Bold token and got rugged, basically, right? This can happen where you least expect it or where you most expect it, it can happen. So the moral of the story is be on your toes always in markets. If you blow yourself up, probably the worst thing that can happen is leaving the ecosystem altogether, because then you have no chance of recovery. But some people will just never recover, no matter how hard they try. They won't learn the lessons that they should have learned, and they won't recover. But others will. They'll recover and go on to make more money than they ever have because they learned from their past mistakes. I think that's the key to life, right? Learning from your past mistakes. But in markets, it's especially true. But yeah, I think on that note, that's where I'm going to end today's episode. So thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give the video a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. No, not tomorrow. Tomorrow's Saturday. Next week. Thanks everyone.